It's December 8th, everyone. Happy to be here. Jason Jacobi, Mark Boyer, Salt and Pepper coming to you live. Merry Christmas, Mark. How you doing today?
I'm doing great. Um, yeah, Christmas season. I love it. So awesome. I love this time of year. It's amazing. Yeah, just the cooler weather, the whole thing, right? Christmas lights and
Yep.
music. It's great. I love it.
Good
So,
food, good
yeah,
times. Absolutely. Absolutely. I've been blaring my Christmas playlist, that's for sure.
yeah,
Playing it when you came in the office yesterday, just trying to I probably got the best Christmas playlist out there. It's just classics. It's just feels good. It's a feel good playlist.
yeah. My favorite movies of all times. My kids, and I probably forced you to watch this too when you're dating my daughter. But the Muppet Christmas Carol is amazing. So I recommend that to anybody. So that's kind of a tradition for the Boyer
That,
family. The
yep, that
grandkids
is a
come over now. It's like, Papa, we gotta watch the Muppet movie. We're like, yeah, Christmas Carol. It's so good. So anyway, check it out.
It is good. It is good. Well, we have a light data week for you this week, but some really good numbers that we can dive into. So we'll keep it short, we'll keep it simple, but hopefully we can be insightful and entertaining as well. Um, but for those of you that are watching on YouTube or listening via your hosted or your preferred podcast platform, we'll kind of run through some things. We'll have an open-ended conversation about it. Again, this show is completely unscripted. We're looking at data, we're talking our thoughts and our feelings through. Think of this like financial therapy 101. So just
All
kidding.
right.
But in all seriousness here, one thing I do want to touch on. So let's talk about the difference, a little teaching moment here. Uh, the difference between disinflation and deflation. So Mark, can you kind of break down the difference between those two categories there?
Wow, you putting that pressure on me. Okay, I thought you were going to answer that one.
Yeah.
All right. Well, let's talk about what is deflation, right? Deflation, which we've heard a lot recently, in the news and so forth. We've had this inflationary increase over the last 2 years. It's been,
Mhm.
it's been on everybody's, radar screen recently. Deflation is basically is interest rates going lower year over year, um, or the inflation rate dropping lower year over year. Um, so if last year, we were at 3% inflation, in a particular area. I think you're showing the durable goods chart right here.
Yep.
Yeah,
Hmm.
okay, so it's up there. All right, there it is. So deflation would be what we're seeing right now in durable goods, where we had a big spike in inflationary durable goods expenses. You see that, COVID happened. We had that spike in inflation in the durable goods area above
The supply
10%, which
chain.
is kind of crazy, right?
Yeah,
And
supply chain, right?
yeah, the supply chain, all those issues. And so we had just a huge increase in prices. We see the durable goods popped way up. And then now, currently, you see that they actually drop below zero. So we're actually getting drops now. Deflation is actually that area of uh, rates going down or costs going down and actually lowering prices year over year. So we've dropped below zero, and we're actually now going lower. So prices of things in durable goods are actually lower than they were, a year or 2 years ago, or whatever that that rate or that time period is.
And good point. So just showing this chart, it can kind of break it down even further. So we've got obviously disinflation, which means prices are going up at a slower pace.
There you go.
Deflation, prices are dropping on a year over year basis or whatever it may be. So prices are lower than they were a year ago or 3 years ago or 5 years ago or a month ago. But disinflation is prices going up slower. So disinflation is good for the overall economy because obviously it's just meaning that the cost of goods are going up slower. That's a healthy figure. When you get deflation over the span of over the spectrum of the full economic kind of playing field per se, to use a sports term, that's bad because that just means the economy is slowing and coming to a halt, which, again, deflation in certain areas, okay, great. We had massive inflation, like you just said, Mark, in the durable goods space. If we're looking back at this chart, supply chain, COVID, coming out of that, prices were through the roof, couldn't get goods. I had clients that owned, merchandising or promotional businesses that obviously got hit really hard because they're waiting on, all their product was just sitting in the water. All those cargo ships were sitting out in the water. They couldn't get the goods in fast enough, and which obviously jacked up prices
Yeah.
across the economy, which obviously we're still reeling down from. So disinflation is the top categories there. Your services are still up over 4%. Clothing and footwear still up over 2. Groceries still up over 2. And again, that's that's a all-encompassing grocery bill is
Yeah.
still up that much. Obviously, there's certain things like eggs or meat that have experienced larger levels of inflation over the past 3 years or so. So, but again, disinflation is really healthy. We're seeing that in the economy. It's been really resilient, which we'll talk about a little bit later with the latest jobs reports. But we're getting real deflation in used vehicles and parts, appliances, and recreational goods. So that's a really good point that I think our listeners and viewers can really see that there's deflation. It's not widespread through the economy, so it's not like, showing signs that the economy is coming to a halt. We're just seeing it in sectors that have been really hit with supply chain issues, which have obviously eased since then.
Yeah. So Jason, question for you. You always ask the questions. Let me ask you this question. So the Fed has a target rate of 2% inflation, right?
Yep.
Or right. Is that 2% disinflation?
Yeah.
Right. That's so. Okay. Just
Mm-hmm.
want to make that clear. So that's a 2% that would be like a disinflation number. We want to drop it down to where year over year prices are only increasing 2% per year. That's the goal
Yep.
of the Fed, right?
Correct. That's a good point.
Yeah. So that's just want to make that clear. Deflation is when actually it drops. Prices have gone down below where they were a year ago. And if you have the Fed is trying to get there, okay, trying to get interest rates lower. Part of that is deflationary. So you have to keep an eye on that. And then that's where now getting into the markets are trying to figure out, always if we're into a recession where that's where deflation happens, where the economy kind of rolls over and starts being negative.
Mm-hmm.
That's more deflationary. So ultimately, the 2% a year goal is a disinflationary number. If that makes sense.
Exactly. And the Fed's
Yeah.
not saying, hey, we want inflation to be at negative 2%. That would be deflationary.
Right.
They don't want that. They want the disinflation of actual positive 2%, which just means the slowing of the rate that the prices are going up. So
Yeah.
good point. I like
Perfect.
good question.
Just some
And
clarity
this,
there, hopefully.
yeah, and this chart, it kind of shows that again, as interest rates, as inflation falls, and we kind of see that, hey, we're probably done here with the Fed raising rates. Treasuries, yields have come down a little bit. Mortgages have come down, which is nice to see. We're in the sevens now, lowest print we've had in quite a while. I think overall we'll probably settle in the 3 to 6% range in terms of mortgage rates, and specifically 10-year treasuries would be pretty healthy for 2024. But again, it all depends on the data and the data that's coming out of our economy, right? I mean, the Fed could keep these rates higher for longer, and obviously that would slow the economy a little bit more. Correct?
Correct. Yeah. No. And the markets aren't factoring that in at the moment, and that's what you're just talking about. And so yeah, we'll see how that plays out. Especially now, we just got some job numbers here recently, actually today, with unemployment.
Yep.
Dropped. Economy looks pretty solid still. So I think it reiterates sort of that higher for longer that we've been
Mm-hmm.
talking about for a while. And so we'll see how that plays out after actually, I think after this Christmas, like we talked about, we're in holiday season. Early 2024 is going to be a very interesting time.
Absolutely. So I want to ask you this question. So is the bull market losing its meaning? Is it losing its meaning? And obviously that's a very open-ended question. I kind of threw that out to you in left field here. So I don't want to catch you off guard, but it's an important question to ask. So I want to put this, I'll give you kind of a T-ball set here to put the baseball on, right? Like, when we're kids, you get the
I didn't need
stand,
it. I didn't need that stand, bro. I just put
so
it
you can
down.
hit a home run. I'm just kidding. but, but I want to put this in perspective for you and then get your thoughts on it. Okay. So historically, we talked about the Magnificent Seven last week, right? And how large of a majority of the S&P 500 that seven represents, right? In terms of total return, in terms of weighting.
30%.
Yep. So historically, the top seven stocks have represented 21% of the benchmark. Okay, considering the end of year averages over the past decade. Okay, now you're looking at it over 30%. Over 30%
Over
in
30.
nearly seven of the 500 that are represented in that index. Okay, so to put this in perspective, the S&P up over 19.8% as of the time of recording here this morning, right? If you strip out those seven stocks, it's up a mere 8%, which is below the 10% average since the inception of the S&P 500 as we know it today. Okay? So, my question begs to you, is the bull market losing its meaning?
Well, yeah, I mean, I think it's yeah, yes and no. I mean, I think that I think in regards to bull market is always, we've talked about this all back. Here's another teaching moment, right? Where did the bulls and bears come from? This idea of like, why do they call it a bull market? Why do they call it a bear market? Remember a long time ago we talked about the fact that the history or people think in the history the story is that the bull market meant that if a bull attacks you and hits you, what does that bull do? It stabs you and throws you up, right?
Yep.
So bull market was up. A
Mm-hmm.
bear is when the bear comes and grabs you, usually going to tear you down, right? I don't want to be messed with either one of the bears or bulls,
Yeah.
but the fact is that's where bear was down, bull was up. So markets, are either bullish, and that people are they're moving in the upward direction, or they're bearish. We went through 2022 in a very bearish market for both stocks and bonds. And, we've been sort of bullish on the market this year, and that's been true. But going back to, the bull bear, and if it's over, I don't think it's necessarily over, but what's interesting here with the Magnificent Seven is you've got stocks like Apple, Microsoft, Alphabet, NVIDIA,
Yep.
Tesla, these seven, Meta,
Meta.
Amazon,
Yep.
they're all factoring, they've had huge runs. And you just made the point
Mm-hmm.
that, they're now over 30% of the index.
Mm-hmm.
And if we took them out, there's only 8% return year to date. I think what it says is that it's going to be really important for, in our opinions, and as Boyer Financial, is that you kind of got to rethink how you're diversified in these portfolios.
Yep.
With that said, you got higher PE ratios in these companies, and really not only those five. I mean, they represent kind of the bulk of it, but there's a lot of other smaller companies that are sort of benefiting also from what? What is it? What's the main market right now that everybody's talking about? Right, AI. All right. So
Yeah.
AI is just It's really, I've heard some analysts call it a transformational kind of industry. It's a transformational change in our in our world today. AI is
Yeah.
going to be something that just changes our lives over the next number of years. And so
Mm-hmm.
it's a technology change. I mean, I remember, I could give you another one is, just really the semiconductor, right? I mean, when I was your age, or now I was probably a little younger than you, but because you're older than people think. But anyway, you're, you had phones, you didn't have cell phones, things just going back to the 80s and early 90s. I mean, there was none of those things. And yet now, our whole lives it's been a transformational change really the last 34 years, but AI takes it even to a new level
Yeah.
that you have to be, these technology companies are just on the forefront of that. And these seven specifically are doing that. So, what it means is they are attractive. They're making good money, but their PE ratios are what, 30 plus versus, versus the S&P 500 that is somewhere in the 17,
19.
18 range, 19 range.
Yep. You're right on. Yeah.
Yeah. So it's kind of like, they're expensive, and can they keep going up? Yes. But, and I think they're a part of every portfolio. You just got to be really careful in here that you don't get overexposed to them, because, yeah, there could be things that come up. You just, again, just remembering that diversification is really important in here. And that's kind of what, we can still be bullish. What we're looking for and been pleased about in this market is that we're actually getting a broadening out of the movement in the market.
Uh-huh.
You're starting to
Yeah.
see small caps participate, maybe some
Yep.
mid caps, which have much lower PE ratios, look to be very attractive in here.
13 and 14. Yep.
Yeah. And, even international stocks, and we talked about that for a little while here. You get really low PEs in global funds, different
European.
places,
Yep.
yeah, that are another part of diversification. So yeah, I think as enjoy the ride with the Mag 7, but just make sure that you're diversified in other areas as well, because they might go flat here for a while. Who knows? You looking at Nvidia, some of these, they've been flat for a while in here, but you're seeing other things go. So it's just important to be diversified and spread out a little bit more.
And I can't harp on that enough, Mark. It kind of upsets me these days, in a good way, in a healthy way, not maliciousness or hate or anything like that. But it just I want to harp on this a little bit more in terms of diversification. I'm gonna say it again: diversification, diversification, diversification. Everybody, no, but there's so many people again, and it's part of human emotion, right? People love making money. I mean, you get a little bit of a dopamine hit. That's why you get people that day trade, right? It's something about it when you're actively engaged in the market and you're buying a stock and then it hits, right? And then you're like, oh my gosh, like you get that high kind of, right? It's kind of like
Yeah,
that gambler's high, basically. Which again, I don't see the markets as gambling when you talk about research analysis, whatever kind of analysis you believe in or utilize. But a lot of people, it is kind of like gambling, right? You're buying a company that maybe has no earnings, no revenue. They're kind of a shot in the dark. And then all of a sudden it hits, you get those companies, kind of like the GameStop the meme stocks kind of, right? At that time all of a sudden it shoots up 1,000%, and so you sell off and you're kind of hooked at that point. It's not just about making money endlessly or making money in one stock and just because it does at one time doesn't mean it's going to continue to do so. Thus the importance of diversification, of research, and taking the emotion out of it, right? So putting it in perspective would be something like Bitcoin. Okay, there's a lot of people. There were a lot of millionaires and billionaires made out of Bitcoin. Remember? I mean, even a few years
yeah,
ago, a lot of people bought homes and started businesses, and we're all in on Bitcoin and still are. I mean, but then you look at it last year. I think it went down like 80%. Okay, 80%, and now it's reared its head again. If you bought the dip, like any times when markets have downdrafts, you get times and opportunities to buy in, and then you're up to 300-400% now because of the spot ETFs of all the big finance companies like BlackRock, investment companies, VanEck or whoever else are trying to get these Bitcoin spot ETFs, which will drive more investors into it, right? Because it's easier to get. You can get shares on an open exchange now instead of having to go and get a Bitcoin purse or mine and do all this kind of stuff. But and I'm sorry, I feel like I'm on a soapbox, and I'm going to stay up here on this soapbox for a second. But again, the importance of diversification, whether it's Bitcoin, whether it's the Magnificent Seven, we want our clients, we want people to make money. That's great. But
sure.
realizing that, hey, it's always harder. I mean, you and I have talked about this. It's always harder to lose money. Like there's a stronger feeling felt when you lose money than it is when you gain money, when you make money, right? It always feels
More
so
painful.
much worse than that high when you actually make money. So it's important for clients and investors to remember this is, hey, while you might be riding the high of the Magnificent Seven or buying the SPY or buying Bitcoin at lows or at downdrafts in the market, and you make money, just remember, hey, I need to stay diversified. I need to stay diversified. I need to stay diversified. So
Yeah. So
I'm off
let me
my
ask you this.
soapbox.
I hear what you're saying. I get it. I've seen it in my experience over many years as an investor, and yeah. So I mean, you're going to have places that really run. So are you saying then that we shouldn't be taking the risk associated with being a part of that, or are you saying that it's good to, obviously we want to make money, that's the point, but as you make money, then what's the game plan as those particular stocks might be have been
Yeah.
beneficial to you, then diversification out of them, or just to make sure you don't have all your money in those? Is that what you're saying? So
Yeah,
just
I think it's
diversifying
the
it.
latter. I think again, I'm not saying you get out completely, right? Like, for example, my favorite company right now, again, personal favorite, is Microsoft. Again, just based off of dividend growth, which is kind of our core philosophy. Companies that have growing free cash flows, companies that are willing to pay their shareholders a dividend as a thank you for owning and investing in their company and their innovation and their growth. They have growing revenues. They're diversified. Their cloud services platform is exponentially ahead of everyone else. Obviously, everyone uses Microsoft Teams and Office and Word and uh, Outlook. So I mean, their tentacles are so far-reaching. Video games, um,
Yeah,
VR,
great company.
AI, everything, right?
Great.
So anyway, my point being is like, yes. So let's say I bought 2.5 to 5% of my portfolio was in, but then it goes up to 10, 15, 20%, which I've seen some equities do, like the Apples, right? They've grown over 66,000% since it came on as an IPO.
Hmm.
66,000%.
Wow.
Okay. So that's including all splits and stuff. So obviously it's had a great run. So
Is that why Gates is buying all the land in the world?
well, Apple's Steve Jobs, but
Oh, I'm
he
sorry. I thought he was,
unfortunately,
yeah, well,
we're
but
talking
Gates
about
too, right?
Microsoft. Yeah.
Or
Yeah.
Steve Jobs.
Sorry. I bounced to Apple there. So Apple has been up over
Oh,
66,000 since its IPO. Microsoft, not so much. Obviously they're kind of hitting their stride right now. They've got some pretty good leadership, and CEO, Sandro Nadella, I think his name is, but anyway, trimming that. So if my 2.5 to 5 grows to 15, 20, 10, 15, 20, trim the earnings back, man.
yeah.
Redeploy that capital into other companies that might fit your goals and aspirations, income needs, whatever it may be, which I think is important. So good question. I'm not saying get rid of it, but let's keep it diversified. Let's keep it within your 2.5 to 5% range, depending on your goals, and then redeploy that capital, or wait for a pullback and then deploy it then.
Yeah, it's good stuff, man. It's good. And that's good advice. And yeah, I miss your transition to Apple. I was talking about Microsoft still, but I think that, and then I'm just seeing where Microsoft with Gates, yeah, anyway, that's another subject.
Mr. Health
But your
Professional.
point is that your point is that on some companies you can really make a lot of money, and
Mm-hmm.
it's good. We've got clients who've worked for companies like that directly, and you've gotten stock options and done really really well,
Yep.
right? So it's but
Mm-hmm.
what then we try to do as they transition out is just again, diversification is just making sure you got money in other places, whether it's other stocks, other industries, uh,
Yep.
other types of investments like fixed
There you go.
income,
Yeah.
right? There's lots of different
Alternative.
things,
Yeah.
alternative investments, all types of things that in order to diversify, because again, it's a basic rule of history that it's wise in managing money to spread your wealth out that way. So that's what we try to work with. The other thing is I like working with in those cases, where we're putting money into ETFs and things. I think it's a place for active management. What I love about the fact of having investments where we are using managers who have the ability to go out and research these companies that you and I we can do our research and get as
Yeah.
much info as we can on the internet. I mean, which has really opened things up. I mean, when I first started in this business, they used to have a book called Value Line that you had, to get any info on a stock, everybody went to the Value Line pages. It was just a book of pages and pages of particular research done on specific companies and just all these, it's just, but now it's the internet with a click, you can go check things out. But I think
Yep.
what I like about, some of the managers we use is that they've been doing it a long time, and that just the way they're set up with the money they manage, they're able to get in and talk to the CEOs and talk to the people, get in and
Yep.
do the
Good
actual
point.
down and dirty research that can get deeper
Mhm.
into these companies and into their industries that that we as just people on the outside doing our internet studies. We just can't get. So I love that fact. And then I like the
Yep.
fact that, there's really good managers out there that do that. So help us again, diversifying and spreading our money out. So, but great point, dude. I mean, I think that's really important and wisdom to talk about in that diversification. So I'm okay if you have a little bit of edge about you and talking about that subject. That's good. And that's wise.
I just work.
Diversification.
Yeah. And it's because we care. We say empowering futures, nurturing legacies. That's our tagline here at Boyer Financial, right? Like our
Yeah.
motto. Like we care about those. We care most about those we serve. We are servants. We really are.
Yeah.
Um,
Trying to be.
Obviously, we believe in that from a biblical standpoint, but also just who we are as individuals and as a firm.
Yeah.
And I know that trickles down from you. So
Yeah, for sure. I mean, we want to serve and do our best with managing. I always think you mentioned Bitcoin earlier too. Just another came to mind is that yeah, you can make tons of money in uh, Bitcoin and small little startup companies, things like that. But I think in any of those cases, I always tell people that just be okay. I mean, if you want to invest in this, just make sure that you invest the amount of money that you'd be okay if that thing went to zero overnight. It
yep,
doesn't crush you. And
yep,
that's really the bottom line of any of these investments. There's lots of companies, Enron, different things back. There's been a lot of
yeah,
companies that have looked really, really good, and then all of a sudden, they're not so good. And so, if everything now you think of a Microsoft, they're so diversified. I think about General Electric though. I mean, it never
hmm
crushed, but I remember General Electric was sort of this company that can never get hit. And man, G, I love now because of how the new leadership has really
yep,
divested a lot of industries, and that G
hmm
stock's amazing. But still, I mean, if you bought GE 20 years ago, there was a period that you didn't make any money for a long time in a great company. But point is, in the Bitcoins and some of these really speculative areas, yeah, there's just a chance that some of them are going to be losers, and you just don't know who those are. So that's again, you're trying to diversify, so that if you did lose money, it doesn't affect your whole, just a portion of your investment, not everything you have. So that's really, really key for people to think about.
Awesome points. I hope everyone listening and watching this takes heed to that. And again, we're doing this because we care. I get fired up because I care, and it's fun. But but yeah, it's all in good heart, and we do care. So if you have any questions, obviously you can reach out to us. We'd be happy to talk in more detail about it, or even do a complimentary. If you're not a client, do a complimentary kind of portfolio X-ray. We'll kind of go through it, look at it, give you our honest opinions. No sales pitch, no nothing, and then obviously maybe see if it'd be an opportunity to work together. If not, great. Happy trails to you. But obviously would love to look at that. But last thing we wanted to talk about this week was the jobs report. Again, this might be more boring, but it affects our economy. Again, so as the consumer goes, so goes the rest of the economy. So it accounts for over 70% of GDP, the consumer spender. But in terms of the jobs report and just seeing where we're going, again, this is looking in arrears, right? So this is last month's jobs report, and total non-farm payrolls. We had the JOLTS this week, labor turnover, all that kind of stuff. So we'll kind of summarize it here just very briefly. And obviously, you had the SAG union and the auto workers unions get back to work. So obviously that factors into job growth as well, because those numbers were taken into account for unemployment. So unemployment overall dropped 3.9 to 3.7%. And then obviously the monthly change in payroll, the 2023 average sits somewhere along the lines of the mid 200s here, low to mid 200s. We came in at 199,000. So a little bit lower than the average for the year. But again, that's not a bad thing. It's just showing that our economy is slowing. That's the Fed's goal of kind of tightening monetary policy and trying to curb inflation and slow the economy without breaking anything. That it's working so far. Again, we haven't felt the full ripple effects of all the rate hikes, but it seems like the economy is slowing, and that potentially, if these numbers still continue to be decently strong, we could have a soft landing. But But Mark, is there anything that you're watching specifically, or maybe that you've seen as a concern, right? Because we're saying, oh, the economy's still pretty strong. Is there anything that maybe on the flip side, if you want to play devil's advocate a little bit?
Yeah. So, I mean, again, these are backward looking numbers. It's important to remember that. I mean, it's not something that, you're going back, and actually we're getting a revision of the November number. It was around
Yeah.
150, I think, before, and then they went to 199. So
Mhm.
they revised them up. But, back to that screen, I mean, what is that? Three out of the last, it's higher than, so it's higher than the last three out of five of the last, going back 5-6 months. It's
Yeah.
the fourth highest. There's been a couple other ones in there that have been higher.
Yeah.
But anyway, point is that part of this is, I think, just the November. You had unions going
Holiday
back, but
season.
also a lot of holiday season.
Yep. See,
A lot of
there
people
you go.
working two jobs, picking up things, so those numbers again, yeah. So as long as, just realize that the Fed has been trying to, I mean, they want to see that number below lower like that. So
Mhm.
when it goes higher, there's all the question becomes like today, markets, interest rates have popped up, 1% plus today on the 10-year, simply because that looks like, we're going to have higher for longer. And again, that's not a surprise to us. And that's something that, we've been talking about that for a while. But it's going to be really interesting to see what happens in in my opinion, early 2024. When people get through these holidays, when they start the new year,
Yeah.
it's going to be interesting to see how, as they look at their pocketbooks, as they look at their expenses, what they decide to do in the new year. Student loans are coming due. There's lots of things there, higher mortgage rate. I mean, they could be, credit card debt. I don't know. It
Yeah.
just depends on if it starts to slow down. And then again, because the employment numbers are backward, we could see lower numbers, January, February in the first quarter, and we'll see what happens. We wouldn't be surprised to see that, actually. And then maybe we're not looking for cuts anytime soon, but maybe second half of the year. That's
Yeah.
kind of what we've been talking about, as it slows down. But yeah, it's going to be an interesting beginning of 2024. So to see how
Boy.
actually the economy kind of plays itself out.
Yeah. And then we got election year, which is always more volatile.
Oh yeah,
Patient, the
yeah, for
patient
sure. Right?
investor will win the day on that one, on that front. Just being patient with volatility and entry points and finding opportunities. But again, just I mean, if even factoring in a slowing economy right now, which obviously we've had, like you said, it's holiday. If you're looking at this chart, food and drinking places, so like services, restaurants, things of that nature, retail jobs, all saw some pretty good increases in employment gains for this
Yeah,
last month here, and then obviously we've had some obviously you know. Deflationary numbers on the administrative support services, credit intermediation, warehousing, storage, building material dealers, manufacturing, things of that nature. So,
that first one's an interesting graph. I mean, administrative support services. So that's yeah, that's interesting. It's a big number right there.
yeah, it is 25,000 of
Yeah.
employment losses from October to November. So, again, is that due
Is
to
that
AI?
AI? Is
Is
that
that
yeah?
due to AI and the automation of industry potentially? That will be interesting to follow along these numbers as months go on and years go on. So,
Yeah.
but then again, factoring in geopolitical uncertainty, OPEC, oil price of oil, they pushed back their latest meeting. OPEC did because they want to talk about curbing production even more, right? Which kind of prop up oil prices a little bit more moving forward. And obviously, if Iran gets more involved, they're kind of doing the saber rattling thing and attacking our ships in the Middle East and bases and things like that. So playing proxy to Hamas. So it's going to be an interesting year just to see kind of what happens. There's a lot of uncertainty, but then there are some global tailwinds. Okay, so there are some tailwinds. Again, if rates do come down, inflation does continue to come down. You've got the Eurozone, Germany, UK, China, even like they're kind of in a recessionary period already. They're kind of ahead of us in that that economic slowdown pattern that we tend to see. So there's good opportunity there to invest, to kind of look and see where they come out of this. So there are some tailwinds, and the strength of the U.S. consumer. If we can get out of this with a soft landing, then it could be off to the races, right? Depending on obvious data dependency that we'll rely on moving forward.
Yeah, so a lot of great points. I would just in all of it, I would just say it's clear that none of us, we speculate. We've been pretty good, actually. I would say, Jason, I mean, I don't want to brag, but we've done pretty good in talking about a rolling recession, things like that. But, but we've also been wrong in other places. And, the reality is that as good as, any investor is, nobody really knows what tomorrow brings. And again, I always use the biblical scripture in Ecclesiastes chapter 11. I mean, Solomon, is quoted, basically is one of the smartest guys, that that God gave him great wisdom. He said, look, divide your bread and get in the game, basically cash your bread on the waters and then divide it between 7 and maybe 8, because you just don't know which one's going to work. Yeah. And then that gets back to your diversification piece, right? And all this information, why it's so important to be diligent in your, in your investing, is staying diversified, because we don't know which one's going to work and what exactly the economy is going to do. We see things, and watch it, and we do our best to try to be in the right place at the right time. But again, I think good solid diversification with good active money management managers who have a history of long-term success, I think, is really important for all of us. And so that's my take on all of it. So it's been a fun time and an interesting few years, but it comes back down to that is being open-minded as an investor, think outside your box, listen, learn more as much as you can, and then don't let fear be your adversary. Jump in, let's go, but do it in a wise way, and that's what diversification is.
Love it. I love that. Good wisdom. Thanks so much, Mark. So probably be back with one more closing bell here before we kind of take some time off for the Christmas season and New Year's, but we'll be back and we'll get to a 2024 outlook once we kind of dive into kind of the macroeconomic picture and as things move forward. So thanks so much for joining us on this journey, for ringing the closing bell with us. Have a wonderful weekend. Merry Christmas. Merry Christmas, Mark. I'll see you in a second. And
you're in the next room over.
You're stuck with me.
I'm stuck. I'm okay. That's good. You're a good guy. I love it. So it's fun. But,
likewise.
Yeah.
Likewise.
Merry Christmas.
All right. We'll see you guys next week.
Bye.